Good morning, everybody. Welcome to another bright day, another fantastic day. Here we are at the Flow Show once again. I'm going to take you through some of the news and headlines and market moves that have gone on overnight and this morning. Hope you're doing well. Just me today. Cayman's off on a well-earned break. Right, we're going to start with the usual fun and games in Japan. It seems you can't take your eyes off this market for a minute. Can't even sleep through it these days. We've had Bank of Japan's Uchida popping up. He's one of the BOJ doves. Okay, so you need to take everything with that slant. And he caused just a little 300 pip move in dollar yen overnight. He said our interest rate path will obviously change as a result of market volatility, economic forecasts, the view on risks, and the likelihood of our projection changing. He says Japan is not in an environment where we will be behind the curve unless we hike rates at a set pace. And then he said we won't hike rates when markets are unstable, which caused the markets to become unstable. Well, dollar yen became unstable, and so did the Nikkei. He said we must maintain our current degree of monetary easing for the time being. If the economy prices move in line with projections, it is appropriate to adjust the degree of monetary easing. If market volatility is very large, so we'll keep a close eye out on moves and their impact on the economy and prices. And then says personally thinks there are now more factors that require being cautious when he was asked about the next rate hike timing. So pretty dovish comments, particularly that one shook the market saying that they won't do anything while markets are unstable. As you can see there, that's that big fat 300 pip candle right there, 144.50-ish we were down at 70s, and we shot all the way up to 147.5 and then went on to tickle 148 before pulling back, but the damage has been done already. So after creating that explosive move, he was out a little later on in the European morning, and he said we need to be careful about communications to the market, and excessive market reactions are not desirable. So after causing an excessive market reaction, he now tries to say that's they need to be careful about communications, but this is the mood the market is in at the moment. Okay, we are still trading with high volatility, and so when you get comments like that, you're going to see big moves. I mean, here we go, 147.5, 148s, 146s, 147.5. You know, these are moves not to be taken lightly, and for me, it's just too much volatility for me to want to get involved in that right now, because you know, you blink an eye and you're offside by 50, 100 pips, and that's not sort of markets I want to be trading right now. What I think we are seeing though still, because we are obviously continuing to move higher off the moves we saw early in this week, those big lows down to 141s. I think this is just more of an unwind of those excessive moves that we've seen. The Nikkei pretty much followed suit last night as well, in line with these comments. If I can find it, there we go. There we go. So as you can see, big moves in there as well around that same time. So really, it looks like the yen is following the Nikkei more than anything at the moment. Although we are seeing a bit of a pickup in US yields as well, which is another thing that dollar yen likes to follow. But the patterns are pretty much the same. So it looks like we're wherever the Nikkei goes, dollar yen is sure to follow. I hope, and I mentioned this in the chat room to one of our guys in there, I hope it doesn't mean that we're in that situation like we are with US stocks, where if Fed heads talk dovishly, the stock market rallies and vice versa. I shouldn't think we need to be in that position, given that interest rates in Japan are only at 0.25%, but you never know. Anyway, know which way the winds are blowing and who's following who and who's driving what bus. At the moment, the Nikkei looks to be in charge as we continue to gain from these lows as well. Right, moving on. It's not been too busy on the headline front, so this is probably going to be a quick one as far as that's concerned. We had some German data out this morning. If I can get to it, here we go. Some trade data as well. A little bit softer on the surplus there, but that's coming in due to that really quite awful export number there, down 3.4%, was expected only to drop 1.5%. Month on month, seeing a positive 0.3, but again, the imports coming in at 0.3%, missing expectations of 2.8%. So overall, still weak activity in Germany, although we have seen some of the other numbers picking up, like wholesale factory orders and that sort of thing. We had that earlier this week. We've got industrial production coming in a little bit stronger as well, 1.4% on the month, beating expectations. So there are some signs of a pickup in certain parts of Germany, but on the trade front, that's yet to be seen. So still very much a lot of weakness there. Over in Canada yesterday, we had their services PMI, not something that the market gets overly concerned with. Is it even on this one? No, it's not. Can I find it? No, not there. Anyway, their services PMI came in a little bit better, still in contraction, 47.3 versus 47.1 expected. There was a survey out from the New York Fed just talking about debt in the US, household debt, and it increased slightly in the second quarter. They also look at delinquency rates, which remain elevated in auto loans and credit cards, but not by much. It was only up 0.6% household debt in total to, or up by 109 billion in the second quarter. The delinquency transition rates for these credit cards and auto loans increased slightly. For those that don't know, there's various stages of delinquency, as they call it over there. There's sort of a mild delinquency where people are struggling, and then there's a more serious delinquency. So overall, there's nothing really flagging any major problems in people not being able to pay back loans. Naturally, higher interest rates put a bit of pressure on, obviously, but it's not at levels where you're seeing people wholeheartedly defaulting on debt or wholesale defaulting on debt in big clumps. So it is an area to watch while rates stay high. The Fed will be watching that very closely as well. We did have a 3-year note sale, which was, it was a little bit average, I think one could say. The big to cover was 2.55 versus 2.67 previously, so a little bit softer there, but around averages, 6-month averages for those numbers. On the take up, again, a little bit soft on domestic, but higher on international take up. But again, we're floating around sort of the average numbers. So, as I say, an average auction for that, but definitely no worries coming from that at all. And that's it on the headline front, as far as I know. What we have got out is our mate Nick Timiraos at the Wall Street Journal. He put out a piece last night just clarifying all the recent bank calls and where they sit. And I'll just pick that up for you now. You can have a look at. So these are all the latest bank calls or when they published them. So some of these are updated, some of these still back to July. As you can see, some of these guys looking for 50 pip hikes in September, and some of them going for 125 pips of cuts for the rest of the year. So that's, if you take it just on 25s, that's 5 25 cuts, and there's only 3 meetings, so they're suggesting 2 50s and then a 25. So we're still floating quite high with some of these, and these are some of the big banks. JP Morgan looking at that as well, Wells Fargo, Goldman's looking for 75 pips, a bit more realistic, but they added another cut in there. So I still think we've still got a bit of unwind particularly in the September numbers, although as you can see, most people are going for 25s, but when the big ones are shouting about it, they're the ones that move markets. So still, I think, as I say, we've got a bit of an unwind to go on that. We can see that reflected in US yields, which continue to tick up. If we look at 10s, again, just having this conversation in the room on what yields can do. I still think there's a bit of scope to see yields creeping higher. We may get back to the 4% level, maybe above. I think it will be a hard ask to see 10s going back to 420 unless we start getting some real hotter data, inflation or the economy or whatnot, that would indicate that the Fed will be slower. So I think there's still a bit of correction to go, but it's probably going to be limited now the market is getting Fed cuts and they're on their path. So it only means rates are going to come lower. So don't take it that yields again all the way back up here into 420s, 430s, anything like that, unless there's some sort of shock or whatever. But as I say, if this continues to creep up, we see a bit more of an unwind of all this move. The dollar's going to follow as well. We're just going to find some balance after that. Stocks, as I mentioned, the Nikkei, again, it's doing a lot of pulling for a lot of stock markets at the moment. We had the S&P overnight. Well, yesterday we trucked up to the 53s. Then we had a bit of a pullback. Now we're seeing another move back up, and we're just doing this stepping up business. When we had this move down here, what I was looking for is if we got another move to those lows, how would it react? We're not even getting close to that. So that's your first indication that this move is just a bit of a one-off, and now we're on the creep back higher. Still not out the woods. A lot of people took a bit of a bashing in all that move there. So, it's going to take a bit of time to come back into the market. But as always, if you just take the longer term view, go out to a wider chart, again, this might only just be a pullback. You haven't even got down to the 38.2 fib of just this move here, this swing from November last year. So the fact we couldn't even tackle that 38.2 doesn't mean that the market's collapsing, as some in the financial press are jumping up and down about. As usual, every time you get a sink in the market, it's the end of the world and we're always going back to 4,000 or wherever. Okay, this is why you use things like fibs, just to see what the market is doing. And if we can't get even to the 38.2 fib of this, it tells you that this may just be a pullback. Does it mean we're going to all-time highs? No idea. What we'll just have to watch is what happens with the price. My rules, you pick your levels, what it has to do to get back higher. The big level for me is still up at 54.5, but we've got some levels coming in between. Got some small levels. We can't get a hold into 53s at the moment, so watch yesterday's highs. Then we got a bit of potential minor support resistance area. 53.30s, 53.90s is the level after that, and then we'll see what happens next. So if you're thinking we're going back to all-time highs, well, you need to break through all these levels first. And if you don't, then that keeps this bearish pressure on, and we don't yet look like we're breaking that trend just yet. So, but these sort of areas will be the decider for that. Coming over to currencies, been a bit quiet in some of the others. Euro, dollar, it's holding up above 109. I think that's probably the key level here. Said it yesterday, 109s, 109.10, 108.90, then down into 108.70. So that's the numbers to watch. If we get back under this 109, then we're probably going back into this box here. But it's holding up, but it's not really making any gains on that. So really take it as this is your battleground. 109, 109.40. We've just been finding resistance just into the 30s. So we know this is a bit of an area. Historically, we've had plenty of price action up here. It goes back a bit further. And then this old level again, 109.60s, which is another one. Let's just go out a bit. So as you can see there, This is that 109.40s, and then this 109.60s. Okay, so it's just these little areas that we've had prior highs. We carved through them in this move, but now we're finding resistance there again. So those are your key numbers for that. So the battleground really 109, 109.40. Take your cues or your clues from a break either side of that. Cable pretty much the same. I was looking at this one again in the room yesterday. It's a bit of we got this bit of a zone here down to this 50 fib from the big figure. So it's really big figure down to 126.70. It's been an area, one of those traffic zones where you get these little support and resistance points all the way along it. So it can be a bit pivotal. That's where we bottomed out so far. But again, we're not really making any inroads in trying to turn around the main part of this trend coming from mid-July. So that's still entrenched. So we need to get back really above 128 to start turning it around, and then 128.50. So in the meantime, just again, watch your levels up here. We've got some small levels, lots of the 40s as well in this one, 127.40, back up towards this old fib here, the 38.2. And that's if we break below here, well, then we're going to be heading lower, and we're probably down to these 126 lows that we saw in June. So don't need to be a genius to trade this one. We're either going to hold 127s and move above, or we're going to break down through 126.70 and move lower. Euro sterling, again, this one's doing its sticky thing that it likes to do. When you come down to levels and you just drag around it, and you drag around it, and you drag around it before making a move. We're doing a similar thing up here. It's holding. This is why I've got these lines on my chart, because again, it's one of these areas that always seems to see some action. So it needs to be respective. I'm still short up here. I haven't added that back still what I cut, the little bits I cut in this move down. Again, I'm just taking, I don't understand why the euro is stronger or cable's weaker. There may be some reasons that, fiscal news from the UK is falling into this one, the upcoming budget and whatnot. That may be why. But when I don't understand something, particularly to do with the fundamentals, because there's no reason why the euro should be stronger than the pounds just based on those. If I don't understand it, I just trade the levels, and that's one kit. Still got my stop 86.30, so I'm not risking a lot even if we do break it. But want to see it below 85.70, and then more importantly below this 85.50 area. Get below there, then we're going to see the top cemented, and we'll see stronger resistance coming in. But for now, it's holding, it's doing its job, and we'll wait and see how long we're sitting here waiting for it to make a move elsewhere. Morning, Angela. Yeah, pretty much so with cable. We've had a move, and really, if you go back to cable, even with these yen moves, it's been pretty tight. You haven't seen 200-300 pip moves in cable on the back of all the yen moves. So it's really not been follower, but the pound has been softer a bit all round, certainly more so than the euro. As I say, I'm not fully understanding why that is, and I don't like trading stuff I don't understand. Yeah, exactly, Gav. 126.15.20. Just those low points around there. Couldn't quite get down to the area before that 126 figure, and then a bit similar to this one where you've got a fib just sitting underneath this old support and resistance area. So again, that'll be another door to get through. If you break that, then we're probably going down 125s, 124.5. Half an eye on dollar China. Not trading it at the moment. Though they are still keeping the fixes in the 713, so there's no signs of panic over there in terms of what these moves are doing. Again, a lot of it's dollar led, softness from the data and market expectations for the Fed, and a bit of yen in there as well with what's going on. So We're just itching the top of this zone here. Again, another one of those areas where we see lots of action going on there. So we're back above the bottom of it, and we're just tapping on the top of it. I'm not inclined to trade this at the moment. Just going to let it do its thing and see what happens from there. The old carry trade that everyone's going on about. And again, we had this discussion in the room. This carry trade term is becoming a big thing in financial press, Twitter, whatever. And I think it's becoming too overbearing. Okay, not everything that's going on in the yen is to do with the carry trade. Yes, it's been a big trade. Yes, it is. There's a lot of money involved in this. But when you talk about the yen in general terms, you know, you've got the Japanese whales, GPIF, all the pension funds, investment funds, and whatnot. Okay, they're moving money around that makes the carry trade pale into insignificance. Okay, so yes, while it is an important thing to look at and concentrate on, because there are obviously big moves happening, it is not the be all and end all of what's going on in Japan and with the yen. Okay, so you know, these market moves can get other people trading out in and out of different assets that have nothing to do with carry trades. Okay, so don't get sucked into the narrative that everything to do with the yen is a carry trade thing, because it's not. And as we mentioned yesterday, you know, if you're talking about what the carry traders are doing, and no one knows what the carry traders are doing, we can only surmise that the higher pairs like dollar mex go, the more people are getting thrown out. That's natural. But again, if you've been sitting in around here, 21s, 20s, 22s, okay, not only have you just been sitting on the carry and earning money for sitting in a trade, you've made profit if you were getting out down here. So maybe a lot of these carry traders have got out most of their trades in this move down here because on the FX front they've made money, and maybe they just left a little bit on. So no one knows for sure what the carry traders have done, whether they're half of them are exiting, 3/4 of them have exited, none of them have exited. Okay, no one knows. So if you don't know, all you can do is trade the levels, just like Gav said in our room today. You know, when you, again, if you don't understand, you know, the ins and outs of the duck's arse, then you just trade your levels. And that's all you can do at the end of the day as traders. So anyway, this one, we're holding around this 1920s, 25, this old fib level. So it's become a bit of a level itself. 1850 is again going to be the important level for me. It's been a level all the way through this saga. You know, big level here. So, you know, if you're not sure, because you're getting some pretty wild swings in this, if you want to be trading it, just put your levels on your charts and then rate them. Which ones are the likely to be the strongest ones? You know, we've got this old fib level, 1920s. It's building up into something. It's an old resistance point, even irrespective of the fib there, because obviously when we traded down to below this level and bounced back to it, there was no fib there. It wasn't this fib down here. So it's already a level, more so than the fib. So, you know, you score these levels. So you think, okay, I'll look at that level. I might trade it, I might not. But it's pretty important because we've had history there. Some of these levels, like this one down here, was just one I threw up just as we were getting this price action on the short-term charts. Is it a level I'd probably trade? No. Same with 18. It was a bit of a level, but it's really become washed out. It's not something I'd look to trade. Get down to 1740s, that's a level I'd look to trade because it's got big, strong history there. And we couldn't quite get down there in that move, which tells us that there's probably some decent buying ahead of it. So again, if you want to trade stuff like this, volatile pairs, you may have 10 levels on your charts. Just rate the ones, or rate all your levels, which ones you think would be the strongest to trade, and just wait for them. And if you don't trade them, if they don't get there, don't trade it. You know, don't go chasing trades just for the sake of it. You know, you could have chased it down here, 1760s, trying to trade off that 1740. You know, okay, it would have been a good trade, that one, but oftentimes they don't work and you end up getting stopped out. because you're not trading your levels. You're just trying to chase a trade. Yeah, Patrick, that's the thing with the press, FinTwit, whatever sources you like to look at, your zero hedges. There's always an extreme situation going on with headlines and stuff, you know. And as traders, if you're listening to headlines, you've got to look through the woods to see the trees, if you know what I mean. You know, we've seen it. Pricing in 130 basis points of cuts for the Fed just because of a softer NFP and a bit of a soggy ISM manufacturing. You know, that's just bonkers. And when you get moves like that, you have to look at the fundamentals and make that judgment call. Are these headlines right? Is this extremism right compared to what the fundamentals are? And well, the market reaction since we've had all that tells you that it's not, because all we've seen is bounces in dollar yen and other pairs and yields and whatnot. And that's the market going, okay, we've thrown our toys at the pram, now we're getting back to sensibilities, shall we say. Right, let's see what else is going on. I'll have a quick look at gold. Not one I'm trading at the moment. All in all, we've still got plenty of volatility in it, but it's not going anywhere new. It's not breaking down. It's not breaking up. You could say we're still just in a very shallow uptrend still. Obviously, this high previously was quite important. Coming up close to that one, not quite taking it out. So when you're looking for, moves and whether things are going to make new highs or not, it's important. Even just coming short by a few pips is a very significant price action move there, because it tells you you're not going higher for now. If we'd have made a move up to even sort of 24.88, another high, it just keeps the momentum going. So this gives you obviously the top side here to watch. My old 23.60s, that's where we touched down on Monday. Again, this is just one of those levels where it's a bit in the middle of the wider range, but it just tends to show up time and time again. Yeah, you get breaks through it and you can pick other levels, but when you've been away from it for a while and you come back, well, then it starts showing up again. So for me, it's all about the range. I'm going to trade it. I'm going to be looking to trade it down, probably sub 23.30, down into the 23 level. But depending on why we're down there, of course, it's all right. Saying I'm going to trade 2300 now when we're trading at 24s, but it depends why we get down there in the first place. But for now, it's looking like keep trading the ranges and take it from there. Right. I mean, I'm going to put you guys to work as well. So if there's anything you want me to look at, then please let me know and throw it up. Otherwise, it's just me waffling on. I've got a pretty low book at the moment. All I've got on is my S&P and Euro Sterling. So I'm not doing an awful lot right now. Again, this volatility has just got me on my toes, or where we've got other pairs not doing an awful lot. Dollar Swiss is another one in recovery mode. Excuse me, I know a lot of you guys and girls like to trade this. So this one coming back as well a bit. Again, this is the dollar side of things just coming back. I don't know whether the S&P have been dabbling in this one because obviously just the same, they don't like volatile moves. They're happy to jump in. We did get back obviously above this 85.5 level, which has proved pretty important. As you can see, price action in there. Let's go a bit shorter. So you get a break, tries to hold, then you get a bit of messing around, another break up, and then boom, you hold it. That's the sort of signals you want to be looking for. If you're not sure, if you wanted to be buying a dip, getting long again of this one, this is the action you need to see. You've got one line on your chart. It's been in play before going back. You just need to see these signals: a break, retest, and hold. That's your clue to maybe try along if that's what you want to do. And if you want it to be short, then you want to see the opposite. You want to see it break down and then hold below. So this one, where's it going next? Could get back up to sort of 85, 87s, 87 and a half, get back into where we've had some prior action up around here. So I'm not trading this one at all, but I know some of you guys and girls are. Longer term, it's looking like we just still got a bit of a range going on, 85 and a half up to these 92s. So plenty to trade in amongst this, but it's longer term, it's not really going anywhere. So probably setting up for a bit of a range trade. Another one I'm keeping an eye on just purely because it's annoying me, was the old Aussie Kiwi. I got stopped out of shorts up here, and I think my stop was 11.30, if I recall. So it didn't go that much higher before we had the big move back. But yet again, it's coming down towards the old magnet level, that blue line we've come back to time and time again. So if you're trading this one, if you're sitting in short still, you've had a nice trade. Can we get back to this level again, 108s, and then see what it wants to do from there. Brian, yep, just done dollar Swiss, mate. You're long, so yep, you're riding a nice train there. You know where you're going to be wrong if it starts pulling back. Dollar CAD. Now we've seen a bit of an uptick in oil, but this is one again that's, aside from this little extension through the highs, this 139, it's going back into the box, albeit fairly slowly, back below 138 again, and again just another signal. 138.60s was resistance on the way up, then we broke it, and now we're just finding resistance, getting close to it again, and then below this fib, we're back below 138. We're back below these series of highs that we saw over the last couple of months. We're back below there, and just looking like we're trying to find resistance there again. So similar pattern, back below these levels, and we start holding below these levels, and then we see if we're going to be taking out the rest of these levels. Again, where can we go? I don't know. I think this one again is back on the oil bus, because, as I said, we're seeing the dollar reasonably firm in some pairs, but this one's coming down again. Oil's been ticking up. We've obviously got this mess going on with Israel and Iran kicking off last night, throwing drones around and whatnot, and retaliation talk and everything. So that's probably helping oil a little bit, which in turn is helping the CAD as well. It's been a while, but the CAD seems to be on the oil bus a bit more tightly than it has been of late. But that bounce not overly strong at the moment. There was headlines out that the US is tendering for 1.5 million barrels for the SPR. So they want to stock up while prices are down here. So it doesn't usually mean much of a move in oil prices, because it's not then going straight into the market and buying it at market. They tender for prices and then see what they get. So demand side of things, fundamentals still point for weak oil. But while it's having a little bounce, thus it's adding to this dollar CAD. I'm still actually running some sell stops below here. I'm keeping those on my books just in case moment. And if we get down here, then I'll probably have a little look. 136.50 is the sort of level I'd look to trade if we get down there. Again, it's just another one of those support and resistance areas that always seems to have a little play around whenever we get there. So that's an area I'd look to maybe try a small long from, and then maybe have another go or add to that down into this area here. But for now, as I say, despite this extension, it really is staying pretty tightly in the range. And yeah, we'll see what it does from that one. Brand, sleeping in, mate. Terrible stuff. Your alarm didn't go off. I don't know what you're getting up this time morning in the first place, being in America the way you are. Right, anything for anything else? Quick look at Aussie dollar. That's continuing to move up. So I'd expect this area again to firm up the support. So that's going to be your key point if you're long from down here. You want to stay above this zone, but we're already running into trouble. We've had the move down. We've had the first bounce from that move around 65, 60, 70, and we're running into trouble there. Just trying to get above it now. So again, if you're on this one, you want it to build upon this break above this level. Get above, start finding that as support. Then maybe we start moving up towards 60, 60s, and then we get back into this traffic area here. But below 65.40 and 65.20s, then we're looking a bit weaker, and this part of the bounce is looking a bit dead cattish. Lots of crosses. Gav saying lots of crosses. Look like previous weekly highs run out and back into the ranges now. Yeah, it's the old elastic band moment, Gav. You know, the market, for whatever reason, algos or whatever, it always goes too far, and then you get the snapback. But the important part is how far does it snap back, and has that extreme move changed the narrative? Has it got the market moving from, you know, a rally sell to a dip buy or vice versa? So it's always the hard part is the afterwards bit. What does the market do now? Does it reverse everything and go back to where it was, or, you know, is the tone set and you know, we're changing direction? Just as I've shown in a lot of these pairs, we've got these short-term trends in play, but when you take them in the context of the wider trends, you know, again, this is obviously a significant move, but take it in the trend since April, we're still maintaining that trend, or trying to maintain that trend. And then you go back a bit further and you see we're still in a larger uptrend, shall we say. Let's go back to let's go to the daily. You know, we're still holding this trend. We're not breaking that down yet. So that's why I always say you need to flip in and out of your time frames just to see. It's all right, you know, being on a short-term chart and just seeing this move down. But when you go to a wider chart, then you see, well, we're just holding this rally and we're not breaking that yet. So it gives every opportunity or signal that we could be heading higher through 130s and maybe even higher. So context is always important when you're looking at, doesn't matter what pair you look at, crosses, anything you like. You know, yeah, we've undone all of this yearly move in that move, but look at the bigger trend. You know, this could be just a pullback. So context is always important. All right, I'm going to call that a day anyway. I've had enough of the sound of my own voice. What we got coming up in the data today? Just having a quick look. Not a lot. Always tends to be a quiet week after NFP week. We've had the ISM2, so we're just going to be headline watching. It's nice and quiet. All the ECB bods are on their holidays, as you can tell, because we're not hearing from them at all. And so enjoy these summer quietness. Have a good one, everybody, and we'll catch you up tomorrow, and obviously see you on F.A.C.E later on. Have a good one.